market update. Okay, so we've got some very bullish markets at the moment. So you could almost call it super bullish. What is happening in the equity space? With equities ripping higher. And look, the catalyst is obvious for this. Is that it's with all the positive progress that's been happening on the trade deal front and tariffs. So obviously with the deal with the US and UK, and then more recently what's been happening with US and China, and especially with the lowering of tariffs from both countries. Now, we did have some important US economic data overnight. That's US CPI for April, so US inflation numbers. So look, if there was anything that could spoil that risk party of the super bullish equity market, certainly it could be inflation numbers. Obviously the market is worried that potentially inflation would rise again. But anyway, last night with those numbers, for the headline number, the market was expecting year on year for the number to come in at 2.4%. It actually came out a touch lower than expected at 2.3%, while the core number year on year was expected 2.8, and it came out exactly as expected at 2.8. But look, the headline number now has actually gone down now 3 months in a row. So that softer number last night was definitely welcomed by the market. So it didn't really need another reason to start trading higher in the equity markets, but obviously getting an inflation number that was a touch lower, equity markets obviously went and spiked north again. Now, immediately after the inflation numbers, we did hear from Trump. Trump came out and basically said that there is no inflation. That basically in China and in Europe that they are basically cutting rates. That the Fed needs to cut rates immediately. That it's not fair for the American public that they're not doing this, and that when the Fed does cut rates, it would be something beautiful. So look, Trump last week was telling the market to buy equities. He's pressuring now the Fed to cut rates. So look, it's very obvious that Trump is doing everything possible, to really spike these markets and get these equity markets a lot higher. Now with the S&P, we talked about at the beginning of the week on Monday that record highs certainly would not be unrealistic, and certainly now we're only a few percent away from record highs. So that could actually happen sooner rather than later. But yes, at the moment, obviously bias is still staying along equities. It is working, and it's working exceptionally well, and you have Trump backing you as well. So very hard to fight this at the moment. Now, look, in the currency space, at the beginning of the week, we had the market basically, getting back long US dollars on the back of trade deals, because that's positive for the US dollar. Last night, with the softer inflation numbers, we saw the market basically giving back some of those, or the US dollar giving back some of those gains from the beginning of the week. So the currency market hasn't been as easy as what the equity market, which has been one-way traffic. So the currency market's been a bit more choppy trading. But one thing that I would suggest is that if equity markets do continue to obviously trade a lot higher, and we take out those record highs and make new record highs, you might want to start looking at some risk crosses, and especially, I suppose, the cross yen risk crosses like Aussie yen. They could be a standout trade following basically equity risk markets higher. So that's something to look out for in the currency space. Moving on to gold. Gold is struggling at the moment. The biggest driver for gold was obviously what was happening with the high tariffs and the trade wars as well. So now that is turning around and we're getting relief from that, so one of the biggest drivers for gold is not there anymore. The US has also said that in the next couple of weeks that they are speaking to at least 24 more countries with respect to trade deals. So expect a lot more positive headlines there. And it was also a headline out just before the market closed today that when Trump comes back from Saudi Arabia on the 16th, on Friday, he is going to be announcing another trade deal. So every time we get those positive headlines, it's going to be a negative and weighing gold. Look, there's one thing at the moment. Technically, there is a potential gap fill still for gold up to 33.20 from Friday's close, where it gaps lower on the China progress. So potentially, that could still happen. If they did, that would be perfect levels to read to some shorts. Having said that, though, there is immediate resistance, much closer to current market, around that 32.70 area. That was a previously very important support. The gold bulls really needed to get back above 32.7 and closing it back above there to see it further upside. But on the downside, the big support level now is 3,200 technically. It breaks 3,200, no doubt we could see gold a lot lower. And further out, potentially we could see it down to 3,000. The other thing that gold traders should know is on Thursday there are talks in Turkey between Russia, Ukraine and the US about trying to solve the war in Ukraine. Look, it's probably optimistic to think that they would actually get a deal done on Thursday, but there potentially could be a ceasefire, maybe even an extended ceasefire, and that sort of positive headline no doubt would weigh gold, because gold's had a risk premium from the war built into it. So again, more positive headlines that gold won't like maybe coming towards the end of the week. And finally, look, just with crypto, yes, Bitcoin is, and crypto space is doing exceptionally well. It obviously has got a pretty high correlation to equity markets, and so when equity markets are doing well, it lifts up a lot of the risk boats, including the crypto. The record highs are up towards 110 for Bitcoin. It's only really less than around $5,000 away. It could do that any time. So we could get Bitcoin record highs before equity record highs. In any case, good luck with your trading midweek, and we'll check back in with you shortly.